Hi, I'm James Varaklis, co-founder and chief compliance officer at IBEX Wealth Advisors. I'd like to welcome you to our mid-year economic and market outlook for 2023. Good morning to you all from our offices here in Bedminster, New Jersey on July 14th, about to begin the second half of 2023. It was only 6 short months ago that I stood in this very spot producing a video that encapsulated the abysmal market events of 2022, a year we would all like to put behind us. In that video, I offered some assessments and perspectives for the first half of 2023, which included calmer waters for both the stock and bond markets, a laser focus on economic data, slowing rate hikes by the Federal Reserve, a significant rally in risk assets, particularly in growth stocks, and opportunities in the fixed income markets, otherwise known as the bond market. While I'm pleased to see that our viewpoints have been validated by market developments, it's crucial to maintain a forward-looking mindset as financial landscapes, market trends, and economic indicators are ever evolving.
A great drive on the golf course is nice, but golf is all about the next shot. Let's take a look at what we can expect from the economy and the markets for the second half of 2023. Starting with the great nemesis of 2022, inflation.
For the better part of the last 2 years, consumer wallets have been squeezed by hot inflation, resulting in a sudden upsurge in interest rates. Despite maintaining a hawkish tone, the Fed does seem to be near the end of tightening, as headline CPI, which stands for the Consumer Price Index, has come down significantly from its peak in June of last year of 9.1%. On July 13th, the CPI for June was released and delivered a positive surprise with a rate of 3%, slightly better than the consensus of 3.2%. It is worth noting that the CPI serves as a crucial indicator for monitoring price trends and assessing the overall economic landscape.
The Federal Reserve looks at year-over-year CPI, not month-over-month. If inflation peaked in June of 2022 at 9.1%, and the CPI for June of 2023 is 3%, it appears as though inflation has dropped, like a rock. This could have very bullish implications for the markets.
While inflation may not be falling as fast as the Fed would like, it is gradually falling to much more manageable levels. We expect CPI inflation will decline to 2.8% year over year by the end of this year, and between 2 to 3% by the end of 2024, even without a US recession.
There remains a burning question for 2023. Does the US fall into a recession, or can the Fed really navigate a soft landing?
The US economy remained resilient in the second quarter of 2023. And this has widened the runway for potential soft landing, which is that delicate balance of raising interest rates enough to stave off inflation, but to not sink the economy. Despite considerable negative consumer sentiment, there are notable reasons to suggest that a recession for 2023 is just not in the cards. Consider the following. Estimates for second quarter GDP show year-over-year growth between 2.4 and 2.7%. Either way, it's pretty good growth. Housing appears to have found a bottom or close to it, and this is likely correlated to the Fed slowing rate hikes. With growth stocks rebounding, there has been a $6.5 trillion increase in net worth so far this year, which has been supporting the cyclical sectors of the economy. And employers are still having a hard time finding employees, and with 300,000 new jobs being added per month, people have money in their pockets and consumer spending remains strong. It's hard to get a recession when consumers are still spending. Now, having said this, I see 2 areas of the economy that could potentially slow growth here in the US. After having spent stimulus dollars on a higher standard of living, consumers have tried to maintain that richer lifestyle by overusing their credit cards. This is not sustainable and may put a dent in future consumer spending, which makes up close to 70% of our economy. Smaller banks are also being squeezed on 2 ends. Exposure to commercial real estate is disproportionately higher for small banks. We know this is a problem because of empty offices and retail space. And by not offering competitive rates for CDs, money has been leaving the smaller banks for better rates elsewhere. In all, banks will be tightening lending to consumers and to businesses, which could indeed have an impact on future growth and earnings.
The markets are off to a good start so far this year, but looking under the hood tells a slightly different story about market participation.
In the wake of last year's broad market sell-off, risk assets sprinted out of the gate, with the S&P 500 surprisingly up over 15% through June. This rally, however, was largely due to just 7 stocks, accounting for over 92% of the market's return. So, what do the markets look like for the remainder of 2023 and beyond? Well, let's start with the bond market. The Fed may well have 1 or 2 more small rate hikes up their sleeve for this year, depending upon what the economic data look like. Either way, it seems as though they are nearing the end of their hiking cycle. If this is indeed the case, incorporating bonds and adding duration into a portfolio at this juncture would seem most prudent. Let's look at the stock market. If economic data continue to show inflation slowing, and I believe they will, then the market rally should broaden beyond the narrow leadership that we have seen in the first half of this year. And if economic conditions worsen through the end of this year and into 2024, the Federal Reserve has plenty of room to actually cut rates to help stimulate the economy, something that is typically very bullish for both stocks and bonds. Thankfully, the markets this year are very different from last year's. We express nothing but gratitude for the opportunity to work together, and thank you for the trust you've placed in our firm. We are proud to be your unwavering ally in your financial journey. Enjoy the rest of your summer, and we look forward to seeing you soon.